What up, doe? It's Langston Hughes and welcome to my channel. Now, by this time, I'm sure everyone has heard about Forex, but may not necessarily know exactly what it is. Well, today is your lucky day because in this video, I'm going to give you the how to start Forex introduction. So let's get to it.
Fingers down my spine. Girl, you look mighty fine. Won't you rub your fingers down my spine? Girl, you look mighty fine. Won't you rub your fingers down my spine?
What is Forex? Forex stands for foreign exchange, simply exchanging one currency for another. In fact, most people that have traveled abroad to another country has participated in Forex. Upon arrival, you search for a money changer, you find that money changer, you give them your USD, your British pound, or your euro for that country's currency. That's Forex. You are participating in foreign exchange, but it's Forex offline. And in Forex trading, we do precisely the same thing, but we use leverage as well to our advantage. Foreign exchange, also known as FX, is the largest financial market on earth. It sees more than 6.1 trillion USD in trading volume per day. And the New York Stock Exchange only sees about 22 billion. So you can see by far Forex is much larger. What is traded in Forex? Many Forex brokers allow clients to trade crypto, indices, oil and gas, metals such as gold and silver, but in Forex, we are simply and solely buying and selling currencies. These currencies are always traded in a pair because the true value of a currency is contingent upon its value against another currency. So for example, Euro USD. This is known as a currency pair.
So what is a currency pair? A currency pair is the quotation of two different currencies, with the value of one currency being quoted against the other. The first listed currency of a currency pair is known as the base currency, and the second currency is known as the quote currency.
What is a base currency?
The base currency is the first currency in any currency pair. The quote currency shows how much one base currency is worth as measured against the second currency. For example, if Euro USD rate equals 1.1724, then 1 euro is worth USD 1.1724. Essentially, 1 euro gets you $1.17.
The first is known as the base currency, and the second is known as the quote currency.
So, what is a quote currency? The quote currency is and will always be the second currency in any currency pair. For example, Euro USD. USD is the quote currency. GBP JPY. JPY, Japanese yen, is the quote currency. NZD, Canadian dollar. Canadian dollar is the quote currency. So it's fairly simple. The first currency is known as the base currency, and the second currency is known as the quote currency. Where is the Forex market located, and when can I take trades? Unlike the New York Stock Exchange or the London Stock Exchange, the Forex market doesn't have a physical location nor central exchange. The entire Forex market operates electronically within a network of banks around the world continuously 24 hours a day, 5 days a week, Monday to Friday, and closed on Saturday and Sundays, which means that trades can take place anywhere as long as you have a smartphone or computer with internet connection. There are three types of currency pairs: major pairs, cross pairs, exotic pairs. The major pairs are 7, and they're the most actively traded pairs in Forex: Australian dollar USD, Euro USD, USD JPY, Great British Pound United States dollar, USD Canadian dollar, USD Swiss francs, New Zealand dollar, United States dollar. Now, the cross pairs are also the major pairs with the one exception: They don't include the USD. And then lastly, we have the exotic pairs. The exotic pairs are considered pairs that belong to nations that are still emerging economies or still developing economies. Although that may not be true for the second one, SGD, Singaporean dollar, which is a well-developed economy, but they've always been known as exotic pairs. We have the Turkish lira, the Singaporean dollar, the Hong Kong dollar, the Mexican peso, the South African rand, the Swedish krona, the Russian ruble. In fact, the list is extensive. There are a number of countries that have a currency, and these exotic pairs can be traded with a major pair. So, as you can see, in the Forex markets, the US dollar is king. It's included in all the major currency pairs, making up 85% of all transactions. So why is the US dollar so powerful? Number one, the United States has the largest economy in the world. Number two, currency is like a stock or share in a nation's economy. And when you have the largest economy in the world, your currency, US dollar, is like its stock or shares. Number three, USD is the reserve currency of the world. Most countries on earth are trading in US dollars, and many countries around the world has USD as the reserve currency. Number four, the United States has the largest and most liquid financial markets on the planet. And number five, the United States has a stable political system.
How can you make money in Forex? The main objective of trading Forex is exchanging one currency for another in hopes that there will be price change in your favor. Now, let's learn how to read the currency quotes.
An exchange rate is simply the ratio of one currency value against another currency. So how do we read the currency quotes? Currencies, as we know, are always quoted in pairs, such as Euro USD or British Pound JPY. The reason they are quoted in pairs is because in every transaction, you are simultaneously buying one currency and selling the other. Here's an example for Euro USD. The first listed currency to the left is known as the base currency, Euro in this example. The second listed currency to the right is known as the quote currency, US dollar in this example. When buying, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. In this example below, you have to pay 1.1724 US dollar to buy 1 euro. When selling, the exchange rate tells you how many units of the quote currency you get for selling 1 unit of the base currency. In this example below, you will receive 1.1724 USD when you sell 1 euro. In this example, we have GBP, JPY, British Pound, Japanese Yen. If you buy GBP, JPY, this simply means that you are buying the base currency, British Pound, and selling the quote currency, Japanese Yen. Buying GBP and selling Japanese Yen. You would buy the pair if you believe the base currency will appreciate or gain value against the quote currency, and you would sell the pair if you believe the base currency will depreciate or lose value against the quote currency. So, to sum it up, if you believe that British Pound will strengthen against Japanese Yen, then you will buy. But if you believe that British Pound will weaken against Japanese Yen, then you would sell.
Now, you've learned about currency quotes. That wasn't hard, was it? Now we're going to teach you some trader lingo. Long, short, bull, bear. What does it mean? I'm sure you heard it before. Well, long means a trader is going to buy. When a trader says, I went long on this pair, I went long on this trade, it means they bought. And short, it means to sell. When a trader says, I went short on this trade or I'm shorting the market, it means they sold. And how about bull and bear, or bullish and bearish? Simply put, bull means to go up and bear means to go down. So when someone says that I'm bullish on crypto or I'm bullish on this currency pair, it means that they expect it to go up. Or when someone says the market is bearish, everything is bear, it means the market is going down. Bullish up, bearish down. Long buy, short sell. It's simple, right? Now you know some trader lingo. Let's move on to discuss the bid, the ask, and the spread. Here's an example.
All Forex quotes are quoted with two prices, the bid and the ask. Generally, the bid price is lower than the ask price. The bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means the bid is the best available price at which you, the trader, will sell to the market. When you want to sell a currency, the broker will buy it from you at the bid price. The ask is the price at which your broker will sell the base currency in exchange for the quote currency. The ask is the best available price you will buy from the market. If you want to buy, the broker will sell it to you at the ask price. The difference between the bid and ask price is known as the spread. On the Euro USD quote above, the bid price is 1.1724 and the ask price is 1.1725. If you want to sell euro, you click sell and you will sell euros at 1.1724. And if you want to buy euros, you will click buy and you will buy euros at 1.1725. So you can see the difference between the bid and the ask is 1 pip because the bid is at 1.1724 and the ask is at 1.1725. 25 minus 24 is 1. So the spread is giving us a 1 pip spread. And that's how you calculate the spread on currency pairs.
Well, we see that the spread is the difference between the bid and the ask. But I know you're asking yourself, yeah, it's the difference between the bid and the ask in pips. So what is a pip?
The unit of measurement to express a change in value between two currency pairs is called a pip or price interest point. If Euro USD moves from 1.1050 to 1.1051, that 0.0001 USD rise in value is 1 pip. A pip is usually the fourth or second decimal place of a price quote. For most pairs, the pip is at the fourth decimal place, but for Japanese yen pairs, it's the second decimal place. A pip is located in the fourth decimal place for most currency pairs and the second decimal place for Japanese yen pairs. Here's an example. Euro USD, 1.71249. This fourth decimal place is where the pip is located. And this last decimal place is known as a pipette. I don't necessarily find that to be very useful information, but just know the last decimal place is a pipette. And this fourth decimal place for most currency pairs is the pip. Now we take a look at Japanese yen pairs. British pound, Japanese yen, 150.923. The second decimal place is the pip. And the third decimal place on a Japanese yen pairs is the pipette. So the second decimal place is the pip, and the last decimal place is the pipette. And for most pairs, the fourth decimal place is the pip.
Now I know you're thinking, Langston, this is dope. This is fresh. I'm super excited and I'm happy for you. And you're probably wondering, how do I know when to buy or sell? Well, there's something called analysis, and there's 3 types. Here's an example.
We have 3 types of analysis to determine when to buy or sell. Fundamental analysis and technical analysis are most widely used. However, some traders do like to incorporate sentiment into their analysis. We'll only focus on the 2 most popular styles. Let's start with fundamental analysis. Fundamental analysis. Each currency belongs to a country. That's why Forex fundamental analysis focuses on the country's economic health, such as employment, manufacturing, international trade, productivity, natural disasters, news, and interest rates. For example, Euro USD. If you believe that the US economy will weaken, which is bad for US dollar, you would execute a buy order for Euro USD, buying euros in expectation that it will increase versus the dollar. If you think that the US economy is strong and the euro will weaken against the US dollar, you would execute a sell, USD order, in turn selling euros in expectation that will fall against the US dollar. There are news sites with dates of key events that provide traders with all the useful information needed to trade with fundamental analysis. The most common site is forexfactory.com. It provides traders with an economic calendar. Knowing the date of key events will help inexperienced traders avoid getting caught in the market during high volatile moments. Events are categorized in 4 potential impacts. Red, high impact expected. That can be events such as a prime minister or president speaking, maybe the central bank of a particular country is speaking or having a gathering. Next, we have medium impact. Not so big of a impact such as high impact, but it can still move the market. We have low impact. Low impact is not really going to cause much movement in the market, but it's still good to note. And lastly, we have non-economic impact. This is events that will not move the market. So when you go over to forexfactory.com, you can go over to calendar, and then you see we have different timings for events. We have the pair. We have the type of impact that they'll cause. AUD has a high impact occurring. And then we also have news articles. So this is good source, forexfactory.com, to use when you are interested in fundamentals. Now let's move on to technical analysis. Technical analysis is the framework in which Forex traders use to study price movement. The belief is that one can look at the history of price to repeat itself in order to determine the current trading conditions and predict potential moves. Using charts with present and past information to visualize historical and present data to allow traders to visualize prices' next move. There are 3 types of charts that help traders analyze price movement: line charts, bar charts, and candlestick charts. Let's take a look at a line chart. A line chart, which most people have seen, is quite simple. A line chart draws a line from one closing price to the next closing price. It doesn't provide a lot of information, but it still can be useful to some traders. A bar chart. Now this has much more information than a line chart. A bar chart is also known as an OHLC chart because it shows the opening, the closing, the high, and the low of price for a time period with each bar. The high of the bar indicates price highest point, and the low of the bar indicates price lowest point. The horizontal hash on the left is where price opened, and the horizontal hash on the right is where price is closed. So open, high, low, close. And this is the range of the price for that bar. OHLC, bar chart. I personally don't use bar charts. I actually prefer candlestick charts. So let's take a look at that. Candlestick charts show the same price information as a bar chart, the open, the high, the low, and the close, but in a more visually pleasing display. Candlesticks still indicate the high to low range via the wicks. The body indicates where prices open and close. So let's take a look at this. We have the open, we have the high, we have the low, and we have the close. The color of the candles indicate if it's bullish or bearish. Usually green candles indicates bullish, and usually red candle indicates bearish. The bullish candle opens at the bottom, goes up, and closes at the top, making it a bullish candle. Whereas the red candle opens at the top and closes at the bottom, making it a bearish candle.
What is a lot size? A lot size is the transaction volume of your trade. It will also indicate the value of your pips per trade. Here's an example.
A lot size is the transaction volume of your trade. It will also indicate the value of your pips per trade. For example, if I made a profit of 10 pips and used a lot size of 1.00, that means I made $100 on that trade based on my lot size or transaction volume. However, if someone made the same amount of pips as me, they stand a chance of making more or less depending on the lot size they use. If someone used 10.00 lots and made 10 pips, then they profited 1,000 from the same trade. Lot size is measured in units. It's the measurement of the amount of currency units you buy or sell. So the number of currency units you buy or sell is a lot size. The 3 most popular are standard, mini, and micro. Let's take a look. So when we look at units, we can see and think about units such as buying stocks or shares in a stock. 100,000 units, right? So if we take 100,000 units, the volume for 100,000 units is 1.00, and the value of 100,000 units is $10 per pip. And likewise, in a mini lot, 10,000 units, the volume is 0.10, and the value is $1 per pip. And we also have micro, 1,000 units, the volume 0.01, the value 10 cents per pip. And you don't have to only put a 1.00 lot size for your volume. If you do a 10 lot size, then you're looking at $100 per pip. If you do a 50 volume, then you're looking at $500 per pip. The value of a pip is always calculated in USD. No matter where you are in the world, no matter what type of currency account you're using, the value of a pip is always calculated in USD.
What is leverage?
What is leverage? Leverage is the ratio of the amount of capital used in a transaction to the required security deposit margin. It is the ability to trade large dollar amounts of assets with small capital. Leverage varies amongst brokers ranging from 1 to 50 to 1 to 500. For example, if you use a leverage of 1 to 300 and you had a capital of $1, you could take a trade worth $300. It allows you to trade more than you have in your account. The larger the leverage, the more you can trade with a smaller amount of capital, but it also increases the amount you risk to lose if the trade doesn't go in your favor.
What is margin?
What is margin? Every time you execute a trade, a percentage of your account balance will be set aside as a deposit in exchange for using leverage. This is a security deposit to the broker in exchange for using leverage. The percentage for margin is based upon the currency pair, current price, and lot size being traded. Simply put, it's the amount of money that traders must deposit from the total account balance to open a trade. When trading Forex on margin, you only need to pay a percentage of the full value of the position to open a trade. And in regards to leverage, for beginners, I only recommend a 1 to 200. That should be suitable.
Order types. When you decide to execute a trade, whether it's a buy or a sell, you have the option of 3 different order types.
A market order is an order to buy or sell at the best available price. For example, if you wanted to buy, you would click buy and your trading platform would instantly execute a buy order at the current price. Do keep in mind, depending on market conditions, there could be a different price between the price you selected and the final price that is executed, especially in high volatile times such as high impact news. This is known as slippage. Limit order. A limit order is an order placed to either buy below the market or sell above the market at a specified price. For example, EURUSD is currently trading at 1.2050, and you decide you want to go short if the price reaches 1.2070. You can either sit and wait for price to eventually reach there and click market execution sell, or you can set a sell limit order at 1.2070, allowing you to be away from the computer. If price goes up to 1.2070, your trading platform will automatically execute a sell order at the best available price. You can use this type of entry order when you believe price will reverse upon hitting the price you specified. A limit order to buy at a price below the current market price will be executed at a price equal to or less than the specified price. A limit order to sell at a price above the current market price will be executed at a price equal to or more than the specified price. So for example, let's say this blue dot here is price. Price is currently right here. You expect that once price reaches here, it's going to reverse to go down. So you put a sell limit at this price. As price goes up, hits that, reverses, and comes down, you're in the trade. The same for a buy limit. Price is currently here at the blue dot, and you suspect that once price comes down here, and then continues up from a reversal. So you would put a buy limit right here, because you're expecting price to come down here and to continue up. Stop order. A stop order is an order placed to buy above the market or sell below the market at a certain price. For example, GBP USD is currently trading at 1.5050 and is heading up. You believe that price will continue in this direction if it hits 1.5060. You can do one of the following to execute. Sit in front of the computer and buy at market when it hits 1.5060, or set a stop entry order at 1.5060. So for example, price is the blue dot. You believe that it's moving in a direction that you want to enter a trade because you believe that once price reaches this area here, you believe it's going to continue going. So instead of sitting and waiting at the computer, you decide to put a buy stop here, and once price goes and reaches this, it puts you in the trade. And it's the same for a sell stop, just the opposite direction. The blue dot here is price. You believe that when price reaches here, it's going to continue going in a downward trend. So you decide to put a sell stop here because you believe that once price gets here, it's only going to continue going down. So you enter it. You're entering in the same direction, but in the future.
Forex trading sessions. Now I know you're saying, Langston, you told me Forex market is open 5 days a week, 24 hours a day. This is true. However, it's not necessarily the best time to trade. Although you can trade anytime within that time frame, and even when the market is closed, your positions and trades are still being held. However, there are specific times that present the most volume in the market. And that's why the market has these sessions, these trading sessions, because Forex is traded all over the world. So we have the Sydney, we have Tokyo, we have London, and we have New York. The 4 main sessions. Let's take a further look at these sessions.
Forex trading sessions. Trading also occurs outside of the 4 main sessions, but the market moves best during trading sessions. So this is in GMT. You'd have to go to Google and convert to your local time frame. It's quite simple to do. The Sydney session begins at 9 p.m. GMT time and ends about 6 p.m. and it's overlapping the beginning of the Tokyo session, which begins at 11 p.m. GMT and ends around 8 a.m. GMT, where the London session is coming in at 7 a.m. GMT and stretching all the way till about 4 p.m. GMT. And then you have the New York session at noon at 12 GMT, and that's stretching all the way till about 9 p.m., touching the Sydney session start. But very important to note about this, and this is really all you really need to take away from this. This session of London around 12 p.m. GMT going all the way to 4 p.m. GMT. New York is overlapping the London session at that time. And this is when you see some of the largest volume in the market during this overlap, because you have 2 of the world's greatest financial centers opening up for trading during the trading sessions. So this is a really good time to keep in mind.
What is a Forex broker? It's a financial service provider that allows you as a trader to buy and sell currencies.
Actually, there's many brokers you can check out. A lot of them are good. I personally like Hugosway.com. You can go over and check them out, especially if you're interested in creating a demo account. There's a link in the description, and you can make your account there. I recommend having a demo account before ever trading a live account, and even before trading at all, getting with a mentor to make sure you can learn as much as possible, and practicing with a demo account, getting better over time, becoming profitable before ever creating a live account. And for some people, that takes a couple weeks. For other people, it takes a couple years. So it just depends on the type of attitude you have towards trading and capabilities you have of soaking up knowledge and being able to execute what you learn. But yeah, check them out, hugosway.com. Make a demo account first. I urge you make a demo account before you ever make a live account if you've never traded before and you don't know what you're doing. And definitely, most importantly, getting over with a mentor.
Okay, you made it to the end. That wraps up this introduction. Don't forget to like, subscribe, and comment below. Let me know if this video was helpful to you in any way at all. If you have any suggestions or you'd like to see any specific content in the future, hit that notification bell because I do intend to release a lot more content about Forex and cryptos. Just follow me on Instagram at Langston Hughes. Share. Tell your friends, tell your mama, tell your cousin, tell your sister, tell your brother, tell whoever you want to tell. I really appreciate it. Hope you enjoyed it. Thank you for your time. Peace.